We're at the 5th annual Mindpath ETF conference, talking to Ahmed Farooq, Vice President at Franklin Templeton Investments. Ahmed, thank you very much for joining us.
Thank you.
And what do you think it is that investors should be focusing on right now when it comes to the fixed income portion of their portfolios?
There's so many moving parts right now. Some advisors think they should go short, but they don't understand that a lot of that short end of the yield curve has been baked into the fact that rates are rising. If they're buying government bonds are much more sensitive to than corporate bonds. All of a sudden, do I start to switch out of there? And what has happened is that the recipe that you were building before is getting tougher and tougher, and then the amount of ingredients that you have, they're just growing at an astronomical rate.
You mean the number of products, the number of solutions that are available? Yeah, I mean, it's vast.
So when you have all that in the mix, and then you have Polo saying rates are going up, and then you have the Feds going up, Feds are going to raise rates, it's a lot of confusion, it's a lot of headache, and all of a sudden, clients are complaining because all they see is negativity on their fixed income part of their portfolio. Because as a lot of the bond portfolios are out there, is that there are premium bonds that are coming down to maturity, coming to par, you see the negative interest rates. A negative performance. So now all of a sudden, you're in this conundrum is that, well, I'm not good at this. I enjoy stock picking, and I have to spend a lot more time on that smaller part of the portfolio. So what do I do? And that's where we're seeing a lot of these active fixed income mandates coming out to the point where you can slice and dice the fixed income market so many times by yourself, or you can get a solution-based mandate from companies that have been in the industry, specifically in fixed income managing on an active side for many number of years.
There's an under-awareness or lack of awareness about all the moving parts of the fixed income market and all the driving forces.
Well, that's what it is. And I was talking to back offices, research analysts across the firms, and they're telling their advisors to be in midterm bonds because they feel a lot of the bonds have priced in rate hikes.
Yeah.
But the overwhelming flows, when you look at some of the research that comes out, it's all been the short end. But they're not being compensated for being short because the money is being made in the middle end. So again, that is just despair because you're figuring out, like, where do I want to be? And the other big thing is that what I hear from a lot of advisors that the only reason they're buying active now, but because there wasn't any active available back then.
That's right.
It was all passive vehicles that were available. So they're saying that, well, for fixed income, for equities on an ETF side, I can go passive and I can switch it up. But because I didn't have many options, that's why I kept it that way. And all of a sudden you're saying, well, if I can go active for maybe cheaper than passive in certain circumstances, why not? And I can now be a little bit biased in the portfolio because, as you know, with a passive mandate, you can't be biased anyway. You got to match the fundamentals of the index because that's considered tracking error. So all of a sudden, if I want some duration management, I want to have higher coupons, I want a higher yield to maturity, I want to be selective versus buying all of the 850 bonds in index, I'll buy 125. That's probably a little bit better story to tell your client that we're actually doing a little bit more specifically in this environment.
I think the difficulty for a lot of advisors may be that they can't really abandon the traditional fixed income allocation in their portfolios.
Oh, they'd love to, but it's just that you can't.
Yeah, they can't because that's what their investment policy
statement shows,
says, right? And so how do you get around that? So, Ahmed, do you have any insight into on the traditional fixed income portion what investors could do that would reduce, for example, the duration risk or the risk of rising interest rates? What's a good starting point?
So I think what has happened in that exact question is that there's been a whole movement to go into short duration as an example.
Right.
But then what has happened is those go to short duration all of a sudden don't feel that they're getting the performance that they're looking for because Polis has done an amazing job of letting the market know that rates are going to rise. So then you go into the middle of the curve. But again, if you're doing it in a passive type situation, you're essentially trying to manage that yourself. If you're a traditional bond buyer, the lack of liquidity, lack of inventory in the bond desk are tougher to do that. A simple bond ladder that used to be able to take care of everything is no longer the case anymore because you can't rebalance. You got to wait till the bonds mature and then you restart the ladder again.
Right.
And that's why what we're seeing is that the growth rate in active fixed income is now at 49% year over year. And more solution-based products are coming out where they're taking all the individual ingredients and building a solution based on what you want. And within the firm of Franklin Templeton, we have a couple that are still in mutual fund standpoint that do that. But I think we're going to see a lot more of them coming out in ETF format where for For a discretionary portfolio manager whose key concern is bulk trading, they would like an ETF version of that, and the wrapper of the ETF may make sense for that client versus that client.
Ahmed, thank you so much for your time.
Thank
It's
you.
been a pleasure talking to you.
Thank you.